Investors say their biggest concern is now bubbles in the market rather than inflation or trade tensions. That's according to a Bank of America survey. It suggests that credit investors have one of the biggest overweights in decades. Barnaby Martin is head of European credit strategy at Bank of America. Barnaby, let's just rake through some of those stories together on the back of your report as well. The bubble-like concerns that people have in markets, the amount of credit that has been soaked up very quickly by parties trying to get exposure here. What do you make of their level of appetite and whether it raises any red flags for you?
Sure. I mean, thanks for having me on. Thanks for flagging the credit survey. I mean, we've done this survey for nearly 20 years, and the most recent overweight is one of the biggest that we've ever seen in the history of this survey. As you rightly say, 59% of our investors are now long the market. I mean, to put that number into context, the last time that the market was this overweight was the summer of 2020. And that period, we were just coming out of COVID. The market was very distressed, assets were cheap, and there was oodles of fiscal and monetary policy. So we're looking at markets that are as bullish as when they were, you know, when things were super distressed and cheap. But it's not just that level of overweight, as you rightly said, it's the lack of concern with what recently were some of the biggest issues for our investors. I mean, just 3% say that trade tensions are now their big worry. I mean, that was a material worry a few months ago. And just 3% say that inflation is their big concern, which is remarkable, really, because we've just had a Fed that has cut rates while acknowledging that they believe the US economy is actually going to go from strength to strength. So what the survey says is that you've got an investor base out there that is seemingly comfortable with a lot of the risks that only a few weeks ago they were quite concerned about.
Barnaby, are you saying that the market is misguided because we're not getting the clues on tariffs just yet? In fact, you have to go digging to find where the evidence is going to be from the hit, and it's retailers saying it's still ahead of us. So you're saying that credit markets are ignoring the risk that could be on the horizon for them?
Credit markets are responding to, you know, what has been, if you like, the greatest tailwind at the moment, which is stimulus. I mean, that in a way allows the market to kind of cover up some of these concerns that they recently had. I mean, now the Fed is cutting. 78% of central banks across the globe are in easing mode. I mean, that's been the big story this year for all assets, both equities and both credit. It's that 2025 has been the third biggest year on record for monetary easing. We've had over 100 net central bank rate cuts this year. The last time you had bigger periods of easing were 2009 and 2020. And of course, those were recession-like, financial crisis-like periods. This year's been anything but of course, we've had such a wave of monetary easing. That's just created enormous demand for credit. I mean, I think what our survey is reflecting is many of our investors are seeing record levels of inflow into their bond funds. They're struggling to put that money to work. But while that is happening, they feel that the market is very bulletproof, and that is definitely being reflected in the survey. If you wanted a red flag from the survey, you would definitely say with these levels of overweight, the next speed bump that we arrive at in markets is likely to see a more exaggerated move wider in the credit markets, simply because of the sheer level of overweights that is being reflected at the moment.
Barnaby, that is fascinating, and some do believe the tailwind we're now getting from credit markets is also further propelling the equity market to feel more comfortable. I want to ask you about the relevance of some of the bankruptcies that I mentioned, because in the vein, typically what can cause more bankruptcies is still high interest rates, or it's a slowdown in the economy. Now, some people believe the amount of stimulus that we're getting suggests that we've got a very strong economic story still yet to unfold. And with the story of interest rates coming down, it's hard to see that too tight interest rates could be another catalyst for further bankruptcies. So with those two bookmarks, how do we think about the prospect of further bankruptcies?
Yeah, I mean, I think looking at how the Fed has characterized their easing in the last few weeks, I mean, remarkable in a way, but the Fed is now easing while their own outlook for the US economy is really one that they see strengthening from here. So I would interpret what the Fed has done as a big easing of financial conditions. Now, that has played out nicely in the form of small cap equities rallying in the last few weeks, and that's a good omen for high yield generally, and therefore it suggests that we're still going to be in an environment of systemically low bankruptcies. So I think what the Fed has done elongates the credit cycle for another period, which is good news. But you're right to highlight that rump of firms that are now struggling. And is it a coincidence? Is it contradictory? I think what it reflects is that in the good times of very low rates in the last few years, there were firms that built their cap structures up that were never really going to be sustainable. And what you're seeing now is come what may with rates, lower in the US and definitely much lower in Europe, those firms are just not able to survive. So we've written on this recently. We call these firms zombies. In the UK in particular, there's a more noticeable rump of firms in the UK that are struggling to make money to cover their interest costs. I don't think it is a reflection of a systemic crisis of credit ahead, but it is a reflection of the fact that there are firms out there that will continue to struggle with the cap structures they took on in the old days. And that is playing out now in some of these firms needing help from restructurings.
Barnaby, the credit story we're talking about today and how it impacts the landscape is fascinating because since the financial crisis, regulators have been very keen to crack down on leverage. And at this point, as we talk about dangers in the market, it feels as though leverage has been fairly low. It's the sovereign that's been the issue. We've been talking about that at length in terms of fiscal positions and the amount of debt. But what you're now seeing in terms of the amount of credit, private credit being soaked up, corporate credit being soaked up, what sort of danger does that bring to a landscape that has been cleared of too much leverage?
Yeah, I mean, you're right. There was some indication in our survey of rising concerns over the themes of sovereign debt levels and also populism in politics. Those were two of the answers that investors said, look, we've got a bit more concerned about in the last few months. But in credit, what's happening at the moment is the market, if you like, is crossing the Rubicon. It's making the decision that they feel companies are safer than their sovereigns. And that really is borne out by, the divergence, if you like, in fundamentals and leverage. I mean, over 70% of governments, developed market governments, have seen their debt to GDP go up in the last few years. But if you look at the health of corporate fundamentals, I mean, Spanish company profit margins have never been stronger in history. So you are seeing a more robust corporate fundamental cycle play out while you're seeing a more, concerning sovereign cycle. The market has said, look, we're happy to price companies as less risky propositions than their governments. And if you look at the case of France, we are now seeing more French credits with lower yields than their respective sovereigns. I think that story will stay for a while. I think the market will get comfortable with that. Of course, in the very long term, it can be a risk because the eventual outcome is that governments maybe look at companies and say, well, look, you're really profitable. We could take some of your revenue to help bring our put our finances back in order. So I think this relationship of companies being priced safer than their governments probably doesn't last forever. But in the meantime, the market's very comfortable with pricing this way.
Barnaby, thank you so much for running us through the latest in the survey and the report. Fascinating conversation. Barnaby Martin with us, Head of European Credit Strategy, Bank of America.